The broadcast is now starting. All attendees are in listen-only mode.
Good evening and a very warm welcome to all of you to India Ratings exclusive webinar on the power sector. I am Saranya Shetty, Manager Corporate Communications and Investor Relations for India Ratings and your host for this webcast. In this edition, as you're aware, we'll be discussing the strength, performance and our view on the overall sector. Our presenters for today is Mr. Vivek Jain, Senior Analyst for the Corporates team, and Mr. Salil Garg, Director Corporates. Both are joining us from Delhi. Few housekeeping announcements before we go ahead. As you know, the webinar technology is interactive. Please post questions for our panelists today. There's a questions dialog box. You can type in your questions and we'll take them once we're done with the presentation. So over to you, Vivek and Salil.
Thank you. So hi everyone, I'll be taking you through the presentation. I also have Salil with me, so we both track the power sector. And so very warm welcome to all of you. So I'll start with what we believe could possibly happen in FY16 for the power sector as a whole. And we definitely see some signs of improvement taking place in the sector. And I'll try to cover the following agendas in today's presentation. First major improvement that we see happening is on the fuel supply. Then I'll talk about how we see the energy deficits panning out in FY16 and what is the government's focus on the renewable space and what is the reason for the focus. Then how we expect the players in the sector to behave in terms of their M&A strategies. And how will the financial health of the state power utilities pan out, given what we have seen over the last 2-3 years and the actions that have been taken by the government. And finally, I'll also talk about why we have come to the outlook that we have presented. So largely, if you see the coal supplies from Coal India, which had been till FY14 a pain point for the entire sector as a whole because of the growth rates that the sector witnessed, as in the output from Coal India grew by a mere 4% CAGR if you look at the period from FY05 to 14. However, post the presidential directive, various clearances being given to the mines of Coal India by the government, we have definitely seen an uptick in the volumes that of 8-month and 9-month FY15 figures. So they definitely point to a very strong growth being seen by Coal India. And we believe this growth could continue going forward also. And we expect a growth in the range of 6 to 7% in both offtake as well as supplies, offtake and production by Coal India, largely driven by the initiatives taken by the present government in terms of providing faster clearances, the technology improvements that we believe would enable Coal India to increase its outputs per man hour, and also in terms of being able to reach greater depths in terms of mining, and also faster resolution of the R&R issues would lead to the output growth that we envisage. Now this particular growth from Coal India would also, the government has said that they would look at lowering the e-auction volumes, wherein close to 58 million tons was the e-auction volume in FY14, and now we are expecting that in FY15 and 16 the e-auction volume should be close to 30 million tons. So that's roughly 28 million tons shaved off from the e-auction volume. What we believe is this e-auction volume, though not substantial, but still would go towards largely meeting the supplies for the power sector. And hence we believe the combined effect of higher production and lower e-auction volume will lead to the supplies to the power sector actually increasing. So if you look at the data from 10 to 14, during 10 to 12, the supplies as a percentage of total offtake was nearly constant at 72%. However, now we believe from FY15 and 16, this number could change substantially and we could witness 79% of the total Coal India output or offtake to be primarily for the power sector. So this gives us some confidence that yes, there is an improvement taking place with respect to the supplies to the power sector. But what we also believe is, given that there is a large capacity that is on stream right now, but which may not be getting adequate amount of coal. So though there is improvement in the coal supplies, but the actual financial profile of the developers will take a higher time to actually reflect this on-ground improved situation. Reason being, if you look at the chart that our table that I presented in front, so we see a clear deficit in terms of the total contracted quantity by Coal India Limited and the output that we estimate in FY16. So there remains a deficit of roughly 60 to 70 million tons, which Coal India has actually, applied higher, as in contracted higher, but is able to supply low. So there's a deficit which needs to be met, and until unless this deficit is met, we see the PLFs or the PAF not being able to reach that 85% availability level for most of these power plants. And hence, we believe that the profile of the independent developers will take a higher amount of time to reflect the improved situation. Also, there is another impact or another development which has taken place in the sector, which is with respect to the output from the captive coal blocks. So, as most of us would be aware that the captive coal blocks were mass cancellation had happened for these coal blocks, as the Supreme Court felt that the process was not legitimate and it did not follow meritorious grounds. So the share of captive coal blocks, however, post the actions that the current government has taken with respect to the e-auctioning process that they have formed up and the speed with which they are trying to execute the entire thing, we believe that the coal output from captive coal blocks could also be on an upswing from FY15 onwards. FY15, if you look at, we are anticipating a 63.6 million ton output from the captive coal blocks, largely driven by the start of the Sasan captive coal block, so wherein the output is likely to be higher. So that is why the FY15 numbers appear, higher. Post that, once the complete auction of these coal blocks, 101 in FY15 and the remaining in FY16 is complete, we can definitely see a much better output from these coal blocks. However, in our projections, we have kept it roughly at 70 million tons, which is not a substantial growth, but still, a fair amount of growth. Largely driven by the fact that these blocks will take some time to at least come on stream, start producing and then contribute. So that is why the assumption for FY16 has been fairly conservative to that extent. Now, the combined effect of these two, as in, we believe a higher amount of coal from Coal India and also higher out from the captive coal blocks driven by the Sasan UMPP. So we believe that the PLF should have ideally improved, and that is what we see in the numbers that we have in front of us, wherein the PLF for beginning June actually has started to improve, though the improvements are minor, as in 2-3 percentage point, but if you look at the overall capacity, this number appears quite significant. So we definitely see a clear trend in terms of higher coal leading to a better PLF. This PLF number would also include the use of imported coal, as the prices of the same have fallen over the last 12 months. So definitely the combined effect of all these three, captive coal block, Coal India production increasing, and the higher possibility of blending or imported coal has led to this increase in PLF. Now, what has happened at the same time is, though the PLFs have increased and there is definitely an increase in generation, because as PLFs increase, as you have higher capacity, generation will obviously increase. But at the same time, in FY14, there was a sharp drop in the peak energy deficit and the peak demand deficit. At that point of time, in our previous outlook also, we had clearly articulated that yes, the demand deficits would continue to remain low, because at that time we had anticipated that demand growth to not be very significant and the supply side would be at the same levels that we see currently. So that is why we had projected that the deficits would still remain at similar levels, and that is where they are currently. Now, going into FY16, what we have done is we have tried to sensitize based on our assumptions on coal output. We have tried to project a demand growth and a supply growth. So what the table that you have in front of you, so basically we have assumed a generation growth of 7.6% in FY16, given the improvements that we believe will happen from coal and other generating assets in India. And at the same time, we have tried to forecast how the energy deficit numbers would look like given a demand scenario. So if we believe the demand were to grow at 9%, then we are looking at similar or slightly higher energy deficit. But if the demand growth were to remain muted at say 3%, then we would be in an energy surplus situation. However, 3% demand growth looks fairly, remote possibility, given that these 8 months have seen roughly 8-9% of demand growth. But if that situation were to happen, then we are looking at an energy surplus situation. But that is a remote possibility in my view. A 7 to 9% number would be realistic, and hence the energy deficits would still remain at similar levels. Now, the current government has, focused on renewable energy in terms of providing, in terms of building a clean India and also lowering our dependence on conventional fuels. So the share of renewable energy, if you track from FY04, it has constantly increased. Over the last 3 years, it has remained largely static because the wind installations had slowed down, which constituted a bulk of the RE sector installations. However, they slowed down in FY12 to 14 primarily because of the withdrawal of GBI-based benefits and your tax benefits, accelerated tax depreciation benefits. Now these have been reinstated. However, we believe the current leg of growth in the RE sector would not be driven by wind, but would largely be driven by solar. Reason being, A, the current government has a greater thrust on solar, and B, we believe the solar capacity itself has reached a tipping point in terms of the prices per unit, wherein you are able to get power at roughly 6 to 7 rupees per kilowatt, which would be close to a landed price for a grid parity based price, and hence could see faster adoption. And this is what I tried to say in the previous slide also, that currently if you look at the share of solar is 8% and wind constitutes a bulk of the capacity addition at 67%. But going forward from 8% solar, we are looking at something like an 11 to 12% solar share in FY16, driven by the two reasons that I mentioned, greater adoption and greater thrust. Also, over the last 1 year, we have, as pointed out in the last outlook at the time of the last discussion, we said that we will witness a large amount of sector consolidation, given at that point of time the valuation of the power sector entities was very low. We had a lot of distressed companies also, wherein they had over leveraged their balance sheets. The rupee had depreciated. There were certain strong players, certain strategic investors. So all of these four things have happened, wherein the valuations have remained low. They've increased, but still they continue to remain attractive. The deleveraging plans of IPPs are still in place. The rupee is still at 63, and with an added incentive that the government is now dedicatedly working towards ensuring coal supplies. So there's a possibility that some of the assets might actually see the light at the end of the tunnel and start receiving coal, which would further accelerate the process in our view. As of now, I've given out a list of 4 or 5 acquisitions that have taken place. And given that the gestation period to acquire an already existing asset is quite low and you can monetize it faster, so there could be a large interest in such assets going forward also. In FY16, we could see further consolidation and further interest from investors. Discom health continues to remain a key challenge for us in terms of how the financial health of the Discoms. We believe it is not something that could change overnight, though the plan had been there in terms of restructuring plans were in place. But we believe it's a long-term process and would significantly take us greater amount of time. Given that FY12 to 14 have seen significant tariff hikes, the possibility of additional tariff hikes and significant tariff hike remains low. We believe more tariff hikes would be in the range of 5 to 10% kind of numbers, and hence there could be certain amount of delay in the actual turnaround of the Discoms that we see in our view. Now coming on to the sector outlook, so based on 2 particular reasons. One, we believe that there are improvements, but the actual reflection of those improvements in the financial health of the operating entities will take a larger amount of time, and the financial restructuring that was proposed is expected to take longer and than what was envisaged. So we believe the sector we have maintained at a stable to negative outlook. On the entities that we rate, we still believe they are fairly resilient because of the fuel supply position that they are into, the entities that they deal with, and the tariff mechanism that they operate in, which is largely a cost plus ROE basis, the support that they receive from the state and the central governments, and obviously the liquidity cushion that they have to support any stress that comes their way. So the outlook on intra-rated entities continues to be stable, but on the sector we believe there is a time that would be taken to see the actual improvements in the financial profiles. Now, what would result in the sector outlook actually changing to negative would be uncertainty continuing over the financial turnaround of the Discoms, fuel availability issues which we see improvement, but then if these things roll back and the fuel availability is actually again a hindrance in future growth, or the government's failure in terms of initiating policy measures which ensure all these issues are resolved in time, could result in the sector being at a negative outlook. I think with that I conclude my presentation in the outlook that we had for FY16. So do you want to add anything?
No, nothing from my side.
Thank you so much for that, Vivek. I'll just check for questions that we have. As pointed out earlier, we would request you to please post your questions for our presenters. Okay, we have the first question here from Mr. Dilip Panchal. Coal prices dropped drastically internationally. So will India get benefited?
Yes, definitely. If you look at the total capacity, so there is a large amount of capacity which is based on imported coal, and all these plants would definitely benefit. And if you look at the past, the reason for why Adani or let's say even Tata's went into trouble was because of the large in terms of partly being escalable and partly being non-escalable.
I'm sorry to interrupt, but could you please repeat? There was some problem with the audio. We couldn't hear you.
Sure. So if you look at the overall capacity on the thermal side, so large part of that capacity, roughly about 5-6% would obviously based on imported coal, primarily on the western coast of India and on the eastern coast of India. So both these capacity, these capacities tended to use a large amount of imported coal. However, during FY 12 to 13, 14, when the prices were actually high, some of these entities ended up making huge losses because of the PPAs being partly escalable and partly non-escalable. Now, once these prices have declined, these guys will obviously benefit, and we will see a greater amount of generation from these assets, and which is clearly visible also in the 8-month or 9-month financials if you look at in terms of both generation and in terms of profitability for these operators. So generation has definitely increased and profitability will follow. So we believe, yes, there would be an improvement.
Okay, another question here is from Mr. Gaurav Chaturvedi. Is accelerated depreciation a help to those companies who are not having power as their core company?
See, definitely, accelerated depreciation is beneficial. You saw a large amount of interest coming in from textile players in the south when this scheme was launched. So yes, there is a definite benefit that the corporates try to derive out of the accelerated depreciation benefit.
We have a question here from Mr. Gaurav Deulalkar. What would be growth scenario for wind power installations post government incentives? And what would be demand drivers for wind energy in future?
See, largely internally, we believe solar would drive the next leg of growth in the RE sector, and we believe its share would increase compared to the wind sector. But on your question as to what growth rates we envisage, we would envisage a growth rate of 8 to 10%, as we have highlighted in the report also on the wind sector. Last 2 years have been very muted for the sector, and even the loan book of players on the RE sector, the NBFCs that we happen to rate on the on this sector. So the actual disbursements are coming in from the solar sector. So wind would grow at moderate levels given these incentives have been replaced, but large focus would still be on the solar sector. Demand drivers, there are 2-3 things happening. A, we are not looking at lower hub heights now, so we are looking at higher hub heights. So you have a greater possibility of higher generation, even in areas, which were earlier you felt that the capital investments were not lucrative. So that could be one of the possible demand drivers. Another is the this incentive that the government has given you in terms of accelerated depreciation and GBI benefits. So this would be the demand driver largely, these 3.
These are all the questions that we've received for now, Vivek. So what I would request you to Louis, if you have any questions that you think could arise and probably have not been asked, if you have something on your mind, then please go ahead. In the meanwhile, we will discuss any other questions that we get. Is there anything that we've missed out or not covered in the presentation but you would like to point out, you know?
Just that I'll make a short note on the coal auction that are happening. So we believe that is something that the government has actually worked out to the advantage of most of the players, and that they've done it quite fast. So these measures, we believe, will go towards, long way towards resolving the concerns that investors had in terms of the transparency that they wanted, in terms of the allocation process. So we are pretty clear how the process will work out in terms of how the reserve price have been set. So there are clear benchmarks, and we believe this auction will actually pave the way for future growth in the coal output from the country. And this has been, according to me, one of the most significant developments that the sector has seen, apart from the government's thrust on increasing the output from Coal India.
Okay, we have a question here from Chirag Nahar. The cost of solar equipments has been a pain point for Indian manufacturers against China and Germany. There are many solar equipment manufacturers in distress. So what is the possibility of turnaround of these companies like Mosabev, Websol, Indosolar, etc.? Even Suzlon has ventured into solar. So what's your view on that?
See, largely the reason for, the distress of these companies is probably known, that, the prices of solar panels crashed heavily. So they were something like $1.50 in, something like FY08, and now they're close to 34, 32 cents. And so that is 32 rupees, 32 cents roughly. So that is what has led to this crash in terms of the Indian manufacturers not being able to compete with both Chinese as well as other equipment manufacturers based in Korea, or the likes of First Solar. So the technology actually has evolved quite a lot, and these guys have been able to use economies of scale, the Chinese guys. For Indian players reaching that scale, despite the government focusing on Make in India, and having a definite clause that roughly X amount of the capacity or X amount of the procurement has to happen from the domestic suppliers, but still their cost of production, given the economies of scale are not there for them, would continue to be high. So there could be some amount of pickup, but yes, actually turnaround could be some time away for these guys, and could be a remote possibility also, in my view.
Okay, next question is from Zain Tariq. Is the intercorporate debt incorporated in your sector's outlook? How does the rating agency see circular debts development over FY16?
See, it is very difficult for us to look at, the circularity in debt, but definitely if we are looking at the individual profile of an entity, we try to take in the entire amount of debt, and, we try to break down. But yes, circularity of debt is something which is hard to track. But individually on the unsecured portion of the debt, as well as, assigning a rating to that entity, so we generally give it the benefit, either entity will try to take a consolidated picture in that case, so that all the intercorporate debts are removed. So that is one way of looking at how the debt at each entity level is, and we obviously try to see a picture wherein how debt is kept at each of the opcos or the holdco level, and then try to see what amount of intercorporate loans exist. But to the extent of circularity, it is difficult to actually say.
Okay, the question here is from Mr. Gaurav Chaturvedi. Will raw material for solar, which is coming from China, affect Indian raw material market? Would you want to discuss that?
So could you please repeat the question, Saranya?
Sure, it is will raw material for solar, which is coming from China, affect Indian raw material market?
No, the solar raw material as such, we do not have the capability to produce as far as the raw material is concerned, if you look at basic silica or the silica wafer, as such we do not have the capacity to do either manufacture silica or the wafer in India. So in any case, we are dependent upon the raw material coming from outside India, whether it is China or the other countries.
Okay, another question is from Mr. Sanat Kumar. What is the future of ancillary power services in India?
Sir, I'm not sure what ancillary power services would mean here.
Okay, we could request Mr. Sanat Kumar to please elaborate on the question. For now, there's a follow-up question here from Chirag. What is your view on gas-based power generation and the chances of resolving the issue between RIL and the government?
See, as of now, what we have, looked at, the data suggests is yes, there's a definite amount of stress on the gas-based assets, given that the supplies have been cut off since March 2014, and the fertilizer sector happens to get the entire allocation from RIL. So yes, definitely there's a large amount of stress on the gas-based assets in the country, and the PLFs speak volumes about the quantum of stress that they are in. So the PLFs happen to decline to close to 30% levels, or even lower in some cases. And some plants have actually zero PLF, as in they're not operating at all. So the question as to how these would be resolved is a very difficult situation, because on imported gas-based plants, if you run it on imported LNG, then the prices are fairly high, and domestic gas as such, the availability continues to remain low. So it's really difficult to comment what solutions the government could look at, but at this point of time, one possible solution is, this gas swapping is there. Then you have gas mixing, wherein imported LNG could be mixed with domestic gas and then sold. So you have higher volumes, but the price is also increased. So that is another solution. But the actual methodology with which this whole affair works out, the calculations and all, that still remains to be seen. So we believe gas-based assets is still a challenge that the government needs to address as of now.
And to answer the second part, which is the dispute between RIL and the government, I believe the dispute has gone to arbitration, and so it is purely dependent upon the arbitration process as of now, and definitely it could be a time-consuming affair. Although at the same time, the government has already increased the gas prices for the other producers, but for Reliance, at what volume or at what timing those increased prices would be applicable would again be decided, I think, under the arbitration process. So in short, it is not easy to resolve this dispute, and we don't see it getting resolved in the short term.
Okay. The follow-up here is: do we see any consolidation in near future?
The consolidation in the power sector is very much evident. As we have pointed out, a number of the larger players like JSW, Tata Power, or Adani are definitely, or even Reliance Power, are interested in purchase of assets, whereas the recent entrants or developers like Avantha Power or Lenco or distressed power developers have obviously shown an interest to exit the power sector. Although the number of deals has been, actual deals which have been effected has been low, even NTPC is an interested bidder or a buyer in the market, and even as recent as today, NTPC has released the list of assets which is shortlisted. So apart from the Indian players, there could be foreign players or MNCs who could be interested in buying. So on one hand, you have stressed assets. On the other hand, you have interested buyers, so definitely some amount of consolidation will take place, but still overall, because a large number of players entered this market, so it's not that the consolidation will lead into the market remaining in the hand of 4 or 5 large players. I would still believe there would be a certain number of smaller players, standalone players, who will probably continue to operate in the near to medium term.
Mm-hmm. Okay, another question here is from Ms. Rashi Varma. What could be the probable ways of investing in companies like HPPL investment routes? How can finance be made available to such companies?
Could you please elaborate this entity which we are talking about?
Yeah, I did mention that here in our comments. So the moment I get another question, I'll let you know. There's another question, how the government is managing the price differential of tariff and cost of production.
Sorry, Saranya, you will have to repeat the question.
I think we've answered this one, right? How the government is managing the price differential of tariff and cost of production, have we?
Actually, Saranya, these questions are not very clear. I don't think we have answered this question.
Okay.
There was even an earlier query where we said that we need some elaboration.
Alright, so in that case, I would request our audience to please elaborate on the questions that we just spoke about. If not, you could also mail us later and we could have the replies organized. What are the, there's another question here from Rashi Varma, which is what are the ECB guidelines for borrowing for 20 years, supposedly 100 million? I'm not very clear. Did you get that, Salil?
No.
No, it is not. The question is again not very clear. I think we're not getting a complete question now.
All right, that's not a problem. As I said, we can probably take this up later through an email conversation, so that should be fine. Yeah, there's another question here. I'll just read that out. With so much of acquisition in last 1 year, as mentioned in the presentation, what was the main reason for that, and can it have negative impact over foreign investors which want to invest in generation side?
No, well, as far as I said, that I believe the acquisitions so far have been very limited. There are larger number of assets which are available for sale, but there are limited number of buyers. And the reason for this large number of assets being available for sale or the impending consolidation is that during 2007 till 2013-14, a large number of inexperienced new players entered the power sector. Now they are facing a risk with respect to especially fuel availability, and also a number of players have got their own balance sheet stretched, and they would like to dispose of these assets and reduce the stress on their balance sheet. So that is the main reason. On the other hand, the larger players see this as an opportunity to acquire assets at an attractive valuation. So that is the reason there is an interest from both the sides, but the number of deals so far has been only limited. We do not, as I said earlier, probably during this financial year also, which is FY16, also we'll see some deals, but it might not lead to a large scale consolidation in the market. And as far as the foreign investor interest is concerned, I believe there are foreign investors who are themselves interested in acquiring constructed assets, because at least then the construction risk is over, and we have seen a few deals in that respect where entities outside India have acquired stake into the operating assets in India, and probably that interest will also increase once we have more clarity on the fuel side.
Okay, this question here is from Gaurav. Considering the existing PPAs, what would be the profitability of players with possible higher auction prices of coal?
Well, as far as the auction prices are concerned, we are yet to see at what price finally these captive coal blocks are auctioned. So this is only a reserve price, but it is very much evident that the auction will take place, or the prices which will emerge will have a direct correlation to the PPA, and the PPA prices vary from player to player, and there is a logistical element to it, because certain plants which are located far from the captive coal blocks, their profitability will be lower because of the transportation cost of coal. So the auction price will vary from block to block and player to player, and as the profitability will also vary. So one cannot generalize on a single number that what will be the profitability for any player after this auction takes place.
The follow-up question here is there any possibility in revision in the existing PPAs?
Well, there is a move to seek revision in the existing PPAs, but as we have seen in case of Tata's as well as the Adani's imported, this thing, the matter is sub judice, and it is once a final verdict or decision is known in that, maybe then we could be clear about the direction the PPAs could take. But as of now, it doesn't look like that it will be that easy to renegotiate PPAs. Then it will open up a Pandora's box, and there could be a large number of demands for revision of the PPAs, not only from the side of the sellers but also the buyers. And DISCOMs could also come across and say that these PPAs are disadvantageous to them, and they would like to regulate. So that's a very contentious issue. I don't see it happening that easily, and that on a large scale. If it happens, it will impact the overall investor sentiment rather negatively, because some of the players could benefit, but then which would mean that the PPAs are not bound, and at any point they could be reopened and renegotiated. So, I will not be in favor of renegotiation of the PPAs on a large scale. And at this point, let's wait for the Supreme Court verdict or decision on the Tata and Adani case before a further step can be taken on this.
Okay, we do have clarification on an earlier question. Remember the question on ancillary power services?
Yes.
So basically what he's saying is, what is the future of ancillary power services in India? By ancillary services, he's talking about voltage control, frequency services, and black start ancillary services like in the US. So would we have any?
I believe this is just maybe a very nascent stage. So at this point of time, difficult for us to give a specific comment on that what kind of growth, what kind of future do we see. This is just purely a very smaller part of the overall power sector scenario. We are largely focusing on the mainline players.
Okay. So those are the questions that we've received till now, but Salil, I would not like to miss out on this opportunity. Just to let the audiences know, Salil was live yesterday on Bloomberg TV sharing his views on the sector. So we'd really like to know what exactly was discussed during the interview. Are there any points that, probably we've not included in the presentation, but you did share that with the audience then. So please.
There were 2 or 3 main themes of that conversation. One pertained to the fuel supplies, the second pertained to how fast those fuel supplies will translate into better financial position for the Indian power sector players. And my view is it will be some time, because even if the fuel supplies are improving, they are not improving to the desired level. The Coal India growth has been 5 to 6%, and it will be difficult for Coal India to reach the 9 to 10% level. As a result, even in this year, we are seeing a shortage of about 60 to 70 million ton of coal for those power producers who have the Coal India based linkage. So eventually, either they will have a lower PLFs, or they will have to rely upon the imported coal. So in both ways, so the impact on the financial position, or the improvement on the financial position of the coal-based power producers, despite improvement in the fuel supplies, will not be immediate, or will not be of the level which could give us a lot of confidence. It will still remain muted, because in any case, Coal India is required to supply only 65% of the ACQ in the first year. So as a result, also the PLF would be lower for those power plants for which it will be the first year of supply from the Coal India. So there is an improvement in the fuel power supply, but that improvement will be limited and will not translate into immediate better financial position across the industry. Second topic of discussion was with respect to the coal block auction, and our view is that by March 31st, 2015, we see at least the first stage of the auction, where 25 coal blocks have been offered to be completed. The second stage, if there is time enough, maybe it could also be completed before 31st March. Otherwise, it will spill into the next year. But overall, the increase in fuel supply from the captive coal blocks will take its own time, because in the first stage it will be only the existing operational coal blocks which will be auctioned. So it will only be a that there will not be a discontinuation of the coal, coal supplies from these coal blocks. Beyond this, the second stage where the non-operational coal blocks are auctioned and they become operational, there could be some time. So although there is a lot of excitement and hope from captive coal blocks, but for again it to translate into substantial a higher amount of coal being available, will see during the year at least we'll see. So it cannot be an immediate improvement in the fuel supplies from the captive coal blocks. Third is the view regarding the stuck projects. There are a number of projects which are stuck because of lack of various approvals or other issues which we have discussed. The main issues are of course the PPAs, either the signing of the PPAs or the availability of coal. Again, on those projects we'll see it's not so easy to resolve all the issues overnight. The main issue of the fuel supply will take its own time despite government's efforts to get resolved. Second issue of the PPAs will also take some time because the various state governments, DISCOMs are involved. They will have their own view and they cannot be coerced into signing of the PPAs, and also the model for signing of the PPAs will also vary from state to state. So at this point of time, the stuck projects will again some time to become viable, will achieve the desired ROCs. But at the same time, there is some improvement. There is a move to resolve the issues. But since the issues are complicated, involve various players, the state governments, DISCOMs, the fuel suppliers, the gas suppliers, the Coal India, as well as the developers, the banking sector. So they will take a fair amount of time before they get resolved. So these are the main three themes of my discussion yesterday on Bloomberg.
Thank you so much, Salil, for that. We have a question here, which is for solar. If payment cycle is against the power sold to state utility by IPP, then what can be the mechanism so as to attract private IPPs to invest in such an environment, or what role can central government play in such case? Would you want me to repeat the question?
Well, I think that as far as the payment cycle is concerned, we believe that for the renewable side or for the solar players, it is not it's still better off than the other players, because the size of the solar or the size of renewable power being supplied is still very small as compared to what is being supplied to by the thermal based generators. As far as what role can be played, the eventual answer doesn't lie with the central government intervention or anybody else intervening and trying to guarantee the payment or trying to take over the payment risk from DISCOMs and transferring it to any other entity, but rather the answer lies in making the DISCOMs more viable, and the FRP which we are seeing, or the regular tariff hikes which we have seen over the past 2 to 3 years, have helped to some extent, but yes, maybe not 100%. So whosoever is making investment into the solar is aware of the fact that there is a substantial amount of counterparty risk at this point of time, which will get mitigated only once the financial position of the power sector or DISCOMs improves.
Okay. So I'm just checking if we have any other questions here which we might have not discussed. Just a moment. Okay, there was a question, but I believe we've already answered that, right? You mentioned the government is completing the auction process very quickly. By when do you expect the captive block auctions complete? So we did give an approximate.
Yeah, but just to elaborate on it, we have about 200 odd blocks which are likely to be auctioned. As I said, the first stage. Maybe by March 31st, 2015, only about 20-25% of such blocks could get auctioned at least, and if the first round is successful, maybe this number could go up to 100, which is about 50% of such blocks, and maybe rest getting auctioned in the next financial year. But that is being hopeful. On the downside, maybe up to 50 blocks will get auctioned in this year, and the rest will spill over into the next year. So a lot hinges upon the response and the success of the whole process in the first round, which gives the government the confidence to go ahead faster for the next rounds.
All right, so those are all the questions that we have. We've covered almost all of them. Thank you so much for joining, and thanks to you, Vivek and Salil, once again. As you all are aware, a detailed report on the sector is available on our website, www.indiaratings.co.in. You could access the same. To get a copy of the presentation shared today, we request you to please email us at investor.services@indiaratings.co.in. Don't forget to like us on our Facebook page or follow us on LinkedIn or Twitter to get regular updates on our webinar series and also for a recording of the webinar. Thank you so much for joining. You have a great evening ahead.
Thank you, everyone.